Welcome, everybody, to the Q4 edition of Viridian Mortgage's VeriSmart Life and Wealth series, where we have smart conversations to build wealth beyond your mortgage. So this is a free webinar for our clients, for our referral partners and friends of Viridian Mortgage. We are an independent mortgage brokerage located in Santa Clara City, licensed in California, plus six other states. Alongside me, you will see on screen Katie Kerr and Maria Guardado, my two co-partners here at Viridian Mortgage. If you have any questions during today's webinar, please feel free to type them into the Q&A. You can see the Q&A icon at the bottom navigation bar of your Zoom window. And if you continue to have questions after this webinar, please feel free to contact either Katie, Maria, or I, and we will put you in touch with either of our panelists. And before I introduce them, I want to just tell everybody, and I'll mention it again at the end of the hour, that our next webinar for Q1 of 2026, I can't believe it's already 2026, but nevertheless, we've planned it. Q1, it's going to be Thursday, February 12th, and the topic will be real estate investing. So Thursday, February 12th, same time, 5:30 to 6:30, and the topic will be real estate investing. So we're super lucky to have two really outstanding professionals with us this evening. I'm going to introduce Louise Cochran. She is first. She opened her practice 14 years ago, but before that, she spent nearly a decade in public and private accounting firms across small, regional, and Big Four organizations. Her background in both audit and tax gives her a well-rounded perspective and a more comprehensive service approach. And despite her strong technical credentials, clients value Louise's energy, her candor, and her approachability. She's actually a person, with a personality. She said, quote, "I want relationships. I want to sit next to clients, not across from them, and explain what's going on so they can make better decisions next year." So clients often get more than tax help when they work with Louise, a natural networker. She enjoys advocating for clients, learning their stories, and identifying areas that they haven't considered, whether that's estate planning, financial advising, or even connecting them with coaches, like business coaches or bankers, to help them grow. Outside of work, Louise enjoys champagne, sushi, and travel. She can do all three at the same time. Her husband and three children share the travel bug, and with friends and family from all around the world, they love exploring new destinations together. Thank you for being here, Louise. Our second panelist is Aaron Rubin. He specializes in financial, estate, and tax planning. And get ready to write down all his credentials because it's very impressive. He received a BA in Economics, Accounting, Spanish from Claremont McKenna College. He graduated cum laude from the University of Illinois College of Law and was admitted as a member of the California State Bar in 2006. After becoming a CPA in 2008, as if that wasn't enough, he received his CFP, Certified Financial Planner designation, in 2010. Aaron started his career in public accounting, working at international CPA firm Deloitte, where he focused on high net worth individual income tax returns. And then he moved to Abbott, Stringham & Lynch, a local CPA firm here in San Jose, expanding his focus to estate and gift tax returns and planning. And then he has been with WRP Wealth since 2009. He has a subspecialty in pre-IPO equity compensation. So get ready to ask questions under that topic, whether it's tax around purchasing company stock, qualified small business stock, or post-IPO strategies. His clients rely on him for tax-efficient solutions. He has truly earned his moniker, as you can see on the screen, as the cap gain killer. Aaron and his wife Libby live on the peninsula with their three daughters, Natalie, Gwen, and Emily, along with their winsome golden doodle, Molly. So he's surrounded by females all day long. So congratulations, Aaron, for all your achievements. And thank you so much for Louise and Aaron for spending time here tonight. I know you guys are super busy individuals, especially as we approach year end. So I really appreciate you imparting your expert knowledge with us tonight. So feel free to unmute and chime in. We want to make this sort of like a conversation as usual. And I think the first topic that we will cover from the homeowner perspective is that, Maria, Katie, and I were always like trying to convince prospective homeowners that buying is better than renting. So let's kind of tackle that first topic. Like, what are some of the tax advantages of being a homeowner at its most basic level?
So, Richard, I'm going to interrupt for 1 second because, I went to law school like you did and have to give a disclaimer. So, again, what we're talking about is educational purposes only. So, for your
Of course.
individual situation, you should definitely consult, a qualified tax preparer or if it's a financial advisor or counsel for that. So, again, sorry, just wanted to quick jump in.
Absolutely. Thank you. And very important. Thanks for the reminder. So, Louise, would you like to take the first question?
Yeah, absolutely. So, I mentioned this to everybody here on the panel that I love real estate. It's amazing. The primary goal in life is to have investments, to have wealth, to retire on, to enjoy. And a lot of our decisions should be made from an investment standpoint, and then have the tax as a sidebar to make sure that, it's affordable. Um, but when you're talking about your own primary residence, the types of things that you can maximize for your tax deductions are real estate taxes and mortgage interest deduction. And there's different limits for those. And so when you're working with your mortgage lender, you definitely want to figure out what kind of house can you afford? What's the monthly payment? And then we start backing into, okay, well, what's the interest deduction going to be for that? What's the property taxes going to be for that? And then we start seeing how the numbers end up going in the hopefully the right direction. But ultimately, I say buy. If you buy wisely, the appreciation factor is a really great thing.
Right. And we'll definitely talk about additional tax advantages later on as you consider selling the property. So let's go a little bit into more detail about that mortgage interest deduction. So
Sure.
around here in the Bay Area, where I think in Santa Clara County, the median sales price is over 2 million. And if you're fortunate enough to put in, even a sizable down payment of 500,000, you're still looking at a $1.5 million loan. And so the deductibility only goes up halfway with that, right?
Yeah, for federal, it's a limit of 750,000. For state, California does not conform. They don't follow suit. So for state, the deduction is 1 million. But we're always looking at federal over state because federal is maybe 25 to 35, 37% of the taxes,
Hmm.
whereas California is 9.3. So we focus on the federals. So yeah, so 750,000. The good news is that you also get a HELOC of 100,000 for that, but you want to make sure that the HELOC and the mortgage are both for acquisition debt or improvements.
Okay.
Those are the only ways you can deduct it. So say you get a HELOC and you use some of that money for a car or an airplane, you're not going to be able to deduct that interest, even though it's being collateralized by the house.
Oh, darn it.
I
Okay.
know.
Shouldn't have bought that plane.
So when
Um,
interest rates were low, I had no problem with it, right? Like,
right.
go ahead, use your equity, buy a plane. If it's only 2% interest, that's better than a credit card. But where it's at right now, you might want to double think that. Once again, disclaimer, talk to
Got
your
it.
tax accountant.
Okay. So if you do have a loan greater than 750,000, then you just have to apportion it, right, for the first
Hmm.
750. That's
Yeah,
where
it's
you can avoid.
prorated. Yeah,
Got
so
it.
the
Got
amount
it.
that's over 750 is disqualified.
Got it. Okay.
Yeah.
Aaron, did you raise your hand?
I did not, but I'll tell you, I always like it when the U.S. taxpayer funds my adventures, and if you can get again using when you would talk about buying versus renting, when you're buying, obviously, again, you're going to get that subsidized interest, and the higher your marginal rate, the more valuable it's going to be to you. So certainly, I'm a big fan of buying for sure.
Well, as a wealth advisor, do you do that buy versus rent analysis frequently?
Not a whole lot, just because I think once you explain it, and again, you're going to get that interest deduction. You're in addition to that, when you're making your mortgage payment, you're putting
Hmm.
money from one pocket to another. When you're making your rent payment, you're doing that for somebody else. So
Paying somebody
you
else's
should,
mortgage.
you're paying somebody else's mortgage. So you may as well do it for yourself.
What about like we get the question a lot where if you decide to pay points for a lower interest rate, is that deductible?
Yeah, it is. It's in the first year, it's deductible, and that's why one of the most important things to give your tax accountant when you're getting your taxes done in the year that you purchased is you provide the closing statement because the closing statement will show the points. The 1098 doesn't always show the points, and so we want to take that in the year of the purchase. Now, if you refinance and you pay for points, that's not going to be a deduction for federal.
Hmm.
It's a 2% limitation that was done away with TCJA of 2018.
Hmm.
But for state, it's still there. So, but ultimately, investment over tax savings when it comes to the points for any kind of refi. But wouldn't
Okay.
you want to save your money by refinancing and getting a lower interest rate?
You you improve your cash flow anyway.
Yes.
Okay, so you can deduct points. You can deduct all the non-recurring closing costs that you incur in getting the loan transaction, correct?
Mhm.
Okay, and then what about property tax or what they call SALT? What is the latest news on how much you can deduct?
Yeah, so let me switch my screen so I have my facts straight. Okay, so
Yeah.
with OB3, or what was previously called the Big Beautiful Bill, we have a SALT cap of 40,000 now instead of 10. That's 40,000 for a single person, or if you're married filing separately, it's going to be 20,000. And this is going to be effective from 2025 through 2029. And what happens is that you have access to a $40,000 deduction for SALT as long as your, and here's an acronym, modified AGI, so MAGI,
Uh-huh.
which is like a form of your taxable income. It's got this kind of crazy calculation to it. You can find it on a line item on your tax return. But
Hmm.
if you go over 500,000, you're going to start seeing a phase out of that and you might get back down to the 10,000. So for those that are
Oh,
wealthy, they're not going to be
okay.
able to see this. The good news is that California does not conform. So you still get the maximum. And then the
Hmm.
other part to add to this is that with this great cap being maximized, it might be in your interest to talk to a tax accountant and see if you want to double up your property tax payment. Our first payments are due on December 10th. The next one's
Ooh,
April
yes.
10th. So you might want to talk to someone to make sure that you're not going over that limit.
Right.
Because what if you are over that limit this year, but you're not going to be next year? Save your extra payment for next year. So timing is of the essence.
Got it. Got it. Yeah. So if you know that now that we have a $40,000 cap, and again in Santa Clara County, a median sales price, you're paying 24,000 a year in property tax alone. So we're definitely going to be able to take advantage of that increased limit.
Hmm.
Property tax is due twice a year, but you're saying like if you pay it within the year, you get to deduct it for that tax year.
Yeah, yeah.
Great. There's a lot of misinformation about the salt tax. I'm glad that you clarified. And once again, I'm going to share my screen just to give everybody kind of like a summary of what we just discussed. And I think we hit all these points. Home equity loans. So as far as people looking to improve their homes or remodel, um, what, how do you characterize something that substantially improves the home to qualify as an expense that adds to that cost basis?
You want to do this one, Aaron?
Yeah, so I mean, again, a couple of ways to look
Landscaping?
at it, right? Definitely, if you're going to elongate the useful life of an asset, that's going to be that's going to qualify as substantial, and then again a large improvement to something also substantial, and so and that's really important because when you have substantial improvement, that is now either it's sort of in that same category as home acquisition, although it's technically not home acquisition, it's just a major improvement.
And
So.
that's
Good.
why with the solar panels on primary residences is such a big deal. if you can use a HELOC to pay for that so that you can write off the mortgage interest because that was used for the improvement of your home. So that
Mm.
interest is deductible. If you do a loan or a lease through the solar company, that interest is not going to be deductible because it's not acquisition debt.
Oh, good tip. Yeah, that's an important distinction.
Yeah. If you can get solar before December 31st.
Say that again?
The big beautiful bill has
Oh,
gotten rid of the solar credit. So as of December 31st, if it's
okay.
not installed, it's no longer a credit.
Okay. So in your experience, either of you, in doing tax returns or looking at tax returns, are there certain things that like are bona fide improvements that can be added to the cost basis? Things that are kind of like questionable, like maybe a pool, let alone solar, or maybe like landscaping. Do those count?
Absolutely. Roofs, repaving, exterior painting. I don't count interior painting because that's just really easy to do. Carpeting, not so much, but hardwood floor improvement, kitchens, bathrooms,
Mm,
electrical. Remember, if you upgrade your electrical, let your insurance company know. I don't know if they're giving discounts for that anymore, but it was a
mm,
thing in the past.
right, right.
Yeah.
And what about the interest on home equity debt?
The first
Whether
100, yeah, the first 100,000 is deductible.
Okay, that's in addition to the interest deduction on the first loan.
750,000. Yes.
And then the interest on that home equity debt, does that have to be from substantial improvements, or is there a pretty blanket allowance for that?
Um,
I,
it's up to $100,000 balance that you get to write off the interest on it, and it has to be home acquisition or improvement. So it
oh,
has to
got
be
it.
those things that are improving the home, so that
Okay.
you can deduct the interest up to a hundred
Did
thousand
that
dollars
ever
worth of
change? 'Cause I
principal.
think like years ago there was you were able to deduct it for anything. I mean, you could like take a vacation, but this was probably pre 2008.
Yeah, I don't know. I don't think so, but maybe people just weren't
Maybe there's no questions asked.
yes.
Yeah,
Okay.
post the tax, I'm sorry, pre-Tax Cuts and Jobs Act, there was $100,000 HELOC, and you generally didn't ask questions, from.
Right.
So yeah,
Right.
I remember those days very fondly.
Okay. As far as the mortgage interest deduction is concerned, does that also apply to other types of occupancy? So if anybody wants to buy a rental property or even a second home, vacation home, does that still apply?
Yeah, yeah, absolutely. So when it's a rental property, like 100% rental, no limit on that mortgage. So have as large of a mortgage as you can afford,
Hmm.
if that's your style. Every single penny of that interest is deductible because it's 100% rental. Now, when you go into mixed use, then there's some pro rata kind of situation going on there that complicates things. But it's just getting information because if it's mixed use, it might be considered a second home or it might be considered a rental. And so second homes are allowed to just have mortgage interest deducted and property taxes deducted up to
Hmm.
the SALT. But a
Okay.
rental, you can do a whole lot more.
Sure. Yeah. I mean, it's just like a small business, right? It's a rental expense, just like
Hmm.
depreciation or anything else that you use
Correct.
to maintain the property. Okay. There's a little thing called Prop 19, but before that even came about, we the homeowners in California benefit from Prop 13, which has been in effect since I think 1978, which limits the annual increases in property tax when they get reassessed. But Prop 19, by my notes, was passed at the tail end of COVID year in 2020, and it became effective the following February. So this is a revision, right, of different propositions that existed before, 60 and 90, as I recall, that allows people 55 or older to transfer property tax base to another property. So let's talk about that. Tell me what Prop 19, how homeowners can take advantage of that. We'll start with just the homeowners in California, obviously, but then we'll talk about more details about how to leverage Prop 19.
Yeah, so I think going back to what people remember is a good start. So again, Prop 13 rate again is that 2%, and then eventually you were able to transfer your property tax basis one time. I think it was one time after age 55, and then you could only do it within your county, and then certain counties had intra-county transfers and certain counties didn't. But the really cool thing was that you could transfer your personal residence to your kids, and not have to have that additional property tax, step up, a step. I don't know how to use that word, but
Reassessment.
reassessment. Thank you. To use that reassessment, and then in addition to that, you had an additional $1 million for non-residential property on top. So it was a pretty sweet deal prior. So 2019 sort of changed a lot of that. So now, you have, if you're over 55, you can move three times, and not unless you have if you have a severe disability, I think you get an exemption, but
Hmm.
generally three times um, during your lifetime. And then you get to transfer um, that property tax basis over to a home of equal, or I think, or lesser value. And so you're that, which is a really, great tool, but with one hand they gave, one hand they took away. And so now, trying to, pass that property on to your kids, and specifically your kids. You can do that transfer, but who your kids have to live in the house. So it has to be their residence too. So it's not just your residence, their residence as well. And that whole $1 million of, non-residential exemption, that went away too. So again, only residents, only for kids that live in the house, and limited to $1 million of excluded reassessment. So again,
Hmm.
a huge reduction in benefit for passing property on to onto heirs.
Okay. Yeah, they definitely close that loophole of for people trying to preserve that property tax base for investment property. But what if you have like, does it have to be primary residence to primary residence?
Yeah, has to be primary residence,
Oh,
primary residence.
okay. So it doesn't matter how
So
many kids you have. You can't like give one house to each kid and get away with that.
you cannot give one house because you can only be the resident of one house. So now that said, let's say, and we've had this in our practice where there's four kids. One of the kids has been living with, mom or dad, helping take care of them for a, period of time. And the other three kids say, hey, our brother or sister, they can continue to live in the house and it can be their residence, even
Hmm.
though technically all four of us haven't, inherited a quarter of the home. As long as one kid claims it as their residence, then it still qualifies
Oh,
as for that $1 million. So if mom
okay.
or dad, had $100,000 property tax basis on it,
Hmm.
the first, 1.1 million would carry over. But let's say the home was worth 2 million, then, that property value, is the basis is now 900,000 instead of the
Right.
1,000.
Right. Okay.
So all you need is
Okay.
one kid to use it as their primary residence.
Does that one kid still have to be on title, albeit a smaller percentage?
They should be on title, right? Because I mean, all four kids own the home. I mean, that's
Okay.
that's what you do.
And my next question is, because we've been asked this a lot too, once they move in, is there any kind of seasoning requirement? How long do they have to stay there if they decide to move
So again,
elsewhere?
my understanding of the rule is that when you move out, then it goes away. Then you're going to end up paying the full freight on the real estate tax once it's no longer your residence.
How would they know?
Well, that is a
No,
different
because
question.
no, because anytime a reassessment is triggered by a change in transfer or change in ownership, right? So you don't really, if you move out, you're not going to file one. So I guess,
What you're supposed to do what you're supposed to do, Richard, if you move out, and because we're all very law-abiding citizens, you are going
yeah,
to
of
take,
course.
you are going to remove your homeowner's exemption from your property tax bill because you're a law-abiding citizen. So
Okay.
then they would know you've already filed the paperwork when you first applied to have that transfer done. So they'll know.
Right, right. Okay, fair enough. Here's a
And
summary of what we just talked about.
and this might be a reason why you don't want to gift portions of your house to your kids while you're still alive,
Yes.
right? Because then you might be shooting yourself in the foot when it comes to Prop 19. Just
Well,
one of the many reasons.
let me dig into that a little bit more because there used to be a Proposition 58, right, which allowed parent-child transfers, grandparent-child transfers with no reassessment. And I believe Prop 19 replaced that, right? So even if they decide not to move and they want to gift a part of their property to a parent or a child, they can no longer do so without reassessment, correct?
Well, a certain percentage, right? So if you have transfer of control, now you have a reassessment. But again, there are attorneys out there who are trying to use LLCs and do fancy things to try to avoid that reassessment.
Mm-hmm.
We'll see how the counties react to it. I'm sure we're going to see some court cases at some point.
Okay, got it, got it. And then you also mentioned that the home has to be equal or lesser value. If it's greater in value, does it also just get prorated,
Yeah,
the
so you're
reassessment?
right. So if you kind of buy up instead, you're going to pay an incremental difference.
Got it. Okay. Okay. We could talk about Prop 19 for a long time, but there's another sort of ancillary issue that I want to also talk about dealing with inheritance. And this is not related to property tax now. So we talked about Prop 19 and how you have to move in as your primary residence in order to preserve that tax base. But now let's talk about the capital gains tax and exemptions that exist for that. Who wants to go first? Let's talk about step up in
Well,
tax bases.
I think I think the Prop 19 and the income tax issue were slash are related. Just because some people will make decisions on either one and not consider the other.
Mm-hmm.
So as you alluded to, right, the proposition Prop 19 passed in November right of 2020. And I think like April 1st was the drop dead date of
Mm-hmm.
2021 to start moving assets around because you could do transfers during your lifetime and still utilize the previous propositions. And so
Right.
people were going to their attorneys and trying to do these transfers to save it. But the problem is that when they were transferring these properties that may have had a low basis in real estate tax, they also had a low basis in for income tax purposes. And so, they were potentially giving up what, probably is the most valuable part of the estate tax law, and that is the step up in basis.
Mm-hmm.
So, when again, we used the parent before, when the parent, dies, assuming that, they were the owners of the property, they end up getting a step up in basis to whatever the value of that property was on the date of their death. So they may have bought it in the 1950s for $60,000, but if today it's worth $2 million, they die as long as it's in their hands. For the kids who inherit it, the basis for which you measure gain or loss is $2 million. So it's a really powerful thing to be able to use.
I think it's one of the biggest, if not the biggest, tax loophole out there. And so when we get asked as mortgage professionals, like, what are you going to do with your departing residence? Are you going to retain it for rental or are you going to sell it? It's nice if you fall under the current capital gains exemption, which is 500,000 per couple, right? But if you're beyond that, then that's subject to capital gains tax, which can all be avoided if you are able to die with your home, right? And you get that step up in tax basis.
Yeah, sure. No, death is a great option for taxes. Um,
And just to drive home that point, I want to share this slide that I made. That yes, you can definitely sell in 2025. And in this example, we have a home that was purchased at a price of 500,000 and sold in 2025 for 1.5. So this is So 500,000 of this would be exempt, right?
Yeah.
And I did this wrong. It should have been a million, but anyway, um, the alternative is if they keep it, and let's say they keep it, rent it out, whatever, and then they sell it 25 years later when the home is appreciated, um, not surprisingly, to a higher price of 3.5 million. So this is the entire gain right here, but you see there's like a big chunk of it that will now be subject to capital gains tax because they've exceeded that exemption, assuming that laws stay the same, of course. And then finally, in the last example, this is keeping the home for life, not selling it at all during your lifetime. Instead of having any of this subject to capital gains tax, you now have zero subject to capital gains tax because this blue line or the blue section is now the entire section because there's that step up, a huge step up in cost basis.
Yeah, and that's I'm glad you put this up because it's when you say keep for life, you know, part of it is whose life. And for a married couple, right? It's community. We're in a community property state here in California, so again, make sure you consult, proper tax representation before making any decisions. But here in California, a piece of community property, when either spouse dies, the entirety of the basis gets stepped up. So you don't have to wait to the second person to die. That first person will again increase the basis.
Okay, so going back to my example, let's say so the first spouse passes away, whatever the fair market value is on the date of death of the deceased spouse, that is the new cost basis. And the surviving spouse can decide to sell it and incur no capital gains tax.
That's right. That's right.
Okay.
And then dies. That's another step up in basis, assuming
Right.
that they retained, ownership of it.
Okay. Or if they sold it, at a price that was less than the exemption at that time, if it's still 250 or
Oh,
whatever.
sure. Yes. Correct.
Right.
Right. Right. Right.
Okay. Okay. Great. Everybody got that? All right. Anything else to add? I think is there such thing as an exemption phase out? I think Louise talked about this. Or
I
talked
don't think
with me at one point.
shouldn't be a phase out for homeowners exemption, section 121, but there's lots of, I mean, with that, the new OBBA makes everything so much more difficult because there's
Of
phase outs
course.
all over the place and it's
I
a mess.
I was referring to the requirement that when you sell it as your primary residence, you had to have lived in it 2 out of the last 5 years, correct?
Correct.
That's right. And owned it for 2 of the last 5 years as well.
hmm There's
Oh,
there's
okay.
there's special exemptions for military if they're being stationed somewhere else. But yes, 2 out of 5 years. So you can live there for 2, own it for 5, or you can live there for 2, own it for 3. There's different ways you can do it, and then we just apply what the rules are. The
Okay.
tricky part comes in is if you've ever used the property as a rental property as well, then your exemption of the 250 for single or 500 for joint or married gets reduced by the amount of rental because you've been able to take advantage of all these wonderful things while it was a rental and write off so much more.
Got it. Okay, I think that's what I think a lot of people don't know. So, married couple, you sell the home after living in it forever, and then you decide to rent it out for 3 years. So then your $500,000
Can be
exemptions
limited.
is going to
Yes.
shrink.
Yes, it's going to shrink, but because you've owned it for 20 and rented it out for, say, what was that example? 5, 3?
3 years
3 years,
to qualify.
your reduction is going to be very small. Whereas if you've
Oh,
owned it for 20 and rented it out for 17 years,
I see.
the ratio is very different.
Got it. Okay. Okay. I mean, you can only rent it out for 3 years anyway, right? Because the rule says you have to live in it 2 out of the last 5 years,
Yes.
right?
Yeah.
So if you only lived in the home for 2 years, and then rented it out for three, then it's a really big reduction.
Correct.
Got it. Okay.
But some
Okay.
people have it as a
Um,
rental and then they move in and then they live in it for 2 years. And that's where it gets messed up.
I see what you're saying. Got it. Got it. Okay. So they look at the entire ownership history.
Entire ownership history.
Oh, I see. Okay. Wow. You learn something new every day.
Yes.
Um, what are the other options for sellers or potential sellers? If you don't want to go through the hassle, you want to take your gains, take advantage of the capital gains exemption. There used to be a rule, right, where you could reinvest that money and not pay tax. What other, and I know that doesn't exist anymore, but what other options are there for homeowners to, defer or avoid paying tax, capital gains tax?
Keep a really good log of all the improvements you've done on the house. If I get someone who's owned their house for 40 years, I go, okay, how many roofs? What else have you done? Da, 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 da. Unfortunately, the generation that's owned their house for 40 years weren't so inclined on redoing their houses like the people who've owned their houses for 5. So
Mhm.
just every time you spend your money on your house, you want to keep an image, a scan, or something, some sort of
Mm.
record. If you're even more detailed, have a spreadsheet and just keep track of all the costs that you're spending because that gets added to your basis. So you buy a house for 1 million, you put in 500,000 of improvements, it's 1.5. Ideally, you sell for 2, you get your exemption for 5, and then the rest of it,
Hmm.
no capital gains. But other than that, Aaron, there isn't anything when it's a primary residence, right? Because the
Yeah, well,
1031 is,
yeah. So, and that's the one thing I think I've pitched this idea to tons of clients. No one's taken me up on it yet. But it's take your residence and turn it into a rental for a couple of years. And then once it becomes an investment property, then 1031 it and then keep it as a rental for another couple of years. And after 4 years, you can potentially do have it essentially a 1031 exchange, but people don't want other people living in their homes, especially the new one. And that means you're gonna have to find someplace else to live for several years, and no one likes that idea.
Wait, my head is spinning because you're converting a rental property into your primary home, and you said you have to live there 4 years,
Well, so you have your primary residence. You
or that
turn
you
it
rent
into
it
a
out.
you turn it into a rental for 2 years. And then you can do your 1031 and then but you can't move into the new house right away. That has to be a rental because you can't take it from a rental to being a residence. It has to go from
Yes, of
rental to
course.
rental.
Okay.
And so you again it just takes a lot of time and and people don't like that.
I mean, your intent doesn't necessarily have to be to move back in to either of those properties, right? If you're just wanting to defer tax
Sure.
liability that has exceeded
Absolutely.
the
You can
exemption.
turn it into a rental and keep it as a rental for the rest of your life. That's cool. But
and
most
then,
people are good.
yeah, like if you turn it into a rental for the rest of your life and you die, then your family gets a step up in basis and depreciation restarts.
That's right.
Yeah,
So
yeah.
it's a buy and hold game most of the time
With real estate, for
with rental
sure,
real estate.
for sure.
Primary, it's tricky.
Okay. This is kind of like a side question, but do either of you feel that Prop 19 is likely to be repealed or modified?
I
I
don't
don't
think
know.
so. I think they have other things to concentrate on right now. Um, Prop 19, I think, was mostly to try and encourage people to downsize so that growing families could grow on the property land ladder and get bigger homes. But interest rates have really discouraged, and the appreciation of homes and the capital gain exposure has really discouraged the
Hmm.
downsizing of homes.
Right,
So I think they're going to have to attack that problem first.
right.
Yeah, I mean, propositions cost a lot of money to run, and you got to find someone who thinks it's important enough to do.
Right. I agree. I don't think it's a perfect law, and I think voters really didn't know what they were voting for back in 2020.
Do they ever know what they're
It is what
voting
it
for?
is. It is what it is. Okay, let's go. Let's talk about self-employed homeowners and how self-employed taxpayers can take advantage of certain deductions they may not know about?
Okay, I'll take that one. So you can have a home office as a self-employed person. You want to be careful because if you have a brick and mortar location, you want to still be able to prove that you do a significant amount of something in the home office and that it's dedicated, meaning that there's no ping pong table in there or there's no guest bed in there. I mean, who really uses a guest room these days? But anyhow, some people do.
Hmm.
So move that bed out. But there's two ways to do it as a self-employed person. We're talking about self-employed Schedule C person. A home office can either be done on a simplified method where it's $5 per square foot, up to $500 deduction. Wait, no, it's larger than that. I can't do math in my head right now. I'll get back to you. And then the other option is to do something called a home office deduction, which is the Form 8829. Now, the tricky thing is if you own your home, then on your 8829, you have to recognize depreciation. You have to chip away at the basis of your ownership in order to take that 8829. And that's when I'm reviewing other people's tax returns and I see an 8829, first place I go is to see if the previous tax accountant was doing depreciation. If they weren't, I start going through that tax return with a fine-tooth comb because I know that there's something wrong.
Mm.
But as home office, you figure out the square footage of your home office and then you apply things like utilities, your mortgage interest, your property taxes, landscaping, any kind of repairs or maintenance that's to the whole home but affects the office. But
Mm.
you also want to pay attention to the repairs specifically to the office because specifically to the
Get
office should be
100%.
100%. Exactly. So again, details, details, details.
Okay.
And let me go find the
And
simplified method.
okay. Um, and then so I know that you have to take prorate the expenses for the entire home based on square footage of the home
Mhm.
office. But then do you also have to prorate it based on the amount of time you use the office, especially
I've
if you have another
only,
office?
right. So I actually see it more often with a home-based daycare, right? A home-based daycare would be more subject to the amount of time usage and you apply that.
Hmm.
But for people that are maybe spending 20 hours in a brick and mortar and 25 hours at home, I would take 100%, but some
Oh,
might say that
okay.
that is aggressive. And so I would explain to the taxpayer what their onus is based on a dedicated workspace and how we're taking the deduction.
I see. So, um, I know that we always hear a lot of talk about from real estate investors, like what constitutes a real estate professional. And I believe that how many hours that do you need to document to be considered? And the benefit being that you can take a greater deduction on expenses you incur in your real estate business. Is that right?
You want to go, Aaron?
Yeah, I believe it's 750 are the hours that you need to become a real estate professional. And then if you're going to try to take losses on individual properties, you need to be a material participant on that as well. So um, yeah, there and that has its own hours requirement.
You need to be both a material participant and have the hours?
And again, yeah, I think you can if you're treating each property as its own individual property, I think you can make an election to treat all the properties as one. Um, but again, I don't do a lot of real estate professional returns. I know enough to be dangerous.
Okay. Yeah, because I no, no, I looked into it years ago about like I know real estate agents obviously are professionals, but I was trying to see if a loan agent could be one too, a loan agent who happens to invest in properties. But if it's like you're a casual real estate investor, they definitely would not be able to prove the time um, spent in the business.
Yeah, it has to be your primary business. It has to be the thing you spend most amount of time on.
Got it. Okay. Another topic I have listed here is high value stocks and RSUs, and I believe this is your area of expertise, Aaron.
Yeah, I'm the cap gain killer, so I should probably.
Yes, and especially here in Silicon Valley where we see a lot of RSU income,
Yeah.
what do those taxpayers have to know?
Uh, so our RSU income is essentially W-2 income when you vest the stock and it comes to you. So if you've had RSUs, you know that you get about half of whatever, the quantity of stock that's supposed to come to you. The strategy around what do you do with the RSU? One, as soon as it vests for you, your cost basis is what the date you received it, what the value of the shares were. So there's really no tax reason to hold on to the stock. Now, if you want to hold the stock because you think it's a good stock, that's up to you. I mean, I'm not here to judge, um, but certainly, I mean, the RSU is sort of the simplest way, and there's less games that you can play um, with an RSU. I mean, there's some tax strategies you can try to employ to get um, to try to eliminate some of that RSU income, but they can be complex. Real estate actually is involved in one of them. If you end up having a short-term rental, like a VRBO, and you can do a cost segregation study, which us panelists we were talking about before, and you can if it looks more like a hotel and less of a rental, then it has different rules associated with it. You can
Right.
start offsetting, regular income. There's other limitations. Again, consult your tax professional for your individual need. But certainly, when you get into stock options, there's more games that you can play. And if you have incentive stock options, the tax on that's a little bit different because it ends up the difference between the strike price, what you're going to pay for it, and the fair market value, that's going to end up on a different part of your tax return called the alternative minimum tax. And we only have 13
Mm.
minutes left. I don't want to go into the AMT. And then if you have a non-qualified stock option, again, it sort of is a blend between that ISO and the RSU, where when you exercise, that delta is going to end up on your W-2 as
Right.
wages.
So there's really no difference as far as AMT and also like triggering tax liability between RSUs and traditional stock options, right? As soon as they vested, you have that liability. So there's really no reason to hold on
Well,
to it.
no, the option you actually have to exercise it, which is why you can play more games with a stock option than an RSU. So your RSU, there's a vesting schedule. The day it vests, it ends up in your account less the tax. The option
Uh,
is intact until you decide to make that purchase. Once you make the purchase of the stock option, that's when the tax gets fixed.
got it. Okay, so you do have more control, and with the RSUs, it's actually dangerous to hold on to because if the stock price goes down, then you've already paid the tax, and then you'll have a loss on top of that.
Yeah. Well, yeah, you're right. I mean, yeah. Yes. Is it more dangerous? I mean, I can construct really dangerous scenarios for you. Back in 2000 when people were trying to exercise their incentive stock options, running up
Oh,
huge bills in their AMT, the price would collapse and then they wouldn't have the money to pay for the tax because
yeah,
the tax wasn't part of their W-2. It was a complete disaster for lots and lots of people.
yeah, yeah. I remember.
And especially, yeah, when the stock becomes worthless, you can't write that off as a worthless debt or anything like that. It's just money lost. So
Really?
so the whole thing is that normally when employees get stock options, it's because the C-suite's wanting to get a huge equity opportunity and then they're going to do their own plan for it. So you have to give it non-discriminatorily, right? And so then what happens is these people who aren't in the C-suite, they exercise a whole bunch because they believe
Mm,
in the company loses value, stock no longer counts for anything.
that's terrible.
Hmm. Yeah. And there was this kind of predatory loan program going on by some private equity for a while where they were helping people. They were loaning money to people so they could purchase their stock options, but they'd
Hmm.
come due at a certain time. But what if the stock wasn't worth what they needed in order to pay back the loan? And so,
Yeah.
I know a few people who had to remortgage their homes because of it. So
Yes.
always run these things by an investment advisor and a tax accountant to make sure that you got all your bases covered and you know what the pros and cons are.
So I want to leave a little bit of time for Q&A, but before I do that, any other year-end tax tips that homeowners can take action with by the end of the year?
My first tax tip is the charitable deduction is changing next year,
Hmm.
and there's now going to be a floor for charitable deduction. So your AGI is going to be it's going to be 0.5% of that is going to be the floor. So if you're making if you're a high earner, it's more significant. So if you're making $1 million a year, the first $5,000 of your charitable deductions don't count. So if
Oh,
you're going to make big gifts, this might be a good year to do it. Or funding a donor advised fund, this might be a good year to do it.
got it. And there's still the what 2% cap, so your range of deductibility is between half and 2%.
Your range, I don't know, I'm following the 2% cap. Well, because the
I thought there was
2%
a cap.
miscellaneous aren't capped. Oh, what's that?
Is there no longer a cap on charitable contributions?
Well, there is a cap. There's a 50% AGI cap and a 60% AGI cap, depending on what kind of charity it is.
Oh,
Um,
okay. Okay, so that's changed.
yeah, but the in the next year, there's also a change for again, if you're a high earner, your taxable income if you're married is over 750,000 ish.
Got it.
Your limit. There's gonna be limitations on your deductions as well. So all things to think about for 2025.
Okay. How about you, Louise?
I think the best person to reach out to is your tax accountant. Be proactive. Reach out to them. Be that thorn in their side and just say, "Hey, what can I do?" Because once 1231 passes, the other thing is give some grace to your tax accountant because we're dealing with a whole bunch of new stuff, and it's not like they said everything is happening as of 2025. There's some things coming in 2025, some things happening in 2026, and some things happening in 2027.
Hmm.
For
Hmm.
example, you can donate to scholarship funds in 2027 and it will count as a deduction, but not in 2026 or 2025. So there's so much going on. There's TikTok people giving advice. And the thing is, they might be giving advice off of proposed regulations, not the
Yeah.
real thing that passed. So
Yeah.
just trust your tax accountant and your
Not
advisors to give you
ChatGPT
it.
either.
Correct. Chat GPT is all based on Reddit and general population comments. It's not something that is being fed by CPAs or enrolled agents or attorneys.
Yes. Yes.
So be
Definitely
careful
true.
of where you're getting your advice from. Dinner parties don't count. Go to the bathroom and dial your CPA and leave a phone message saying, "Hey, I just heard this. Does this count?" Most likely not.
100%. Stay very close to your tax professional. Call Aaron, call Louise.
Yeah,
Let's
yeah,
see if
but
there's,
finish in the bathroom before you call me. I mean,
No, you're not going to the
well,
ba- oh, never
well,
mind.
you said go to the bathroom. I'm
depends.
like,
Yeah,
well,
like
If
pretend.
it's New Year's Eve, December 31st, it might be
oh, I
urgent.
see. Okay, I
Yeah,
was like,
don't
well,
get divorced on December
maybe
31st.
But have your child.
Right.
Okay.
True.
the other thing I want to warn people, just in case you're one of these people, the gambling rules for deducting gambling losses has had a huge change for 2026.
Oh, I read about that. Yeah.
So and I have a professional gambler client, and he is really upset.
Just real quick, what is the major change?
So the major change is starting in 2026, you can only deduct 90% of your worth of your gambling winnings. So if you make $100,000 and you lose $100,000 while gambling, you will show a gain to the government of $10,000.
What?
Yes. It's outrageous. I don't know why they did that, but
Probably to limit the amount of like bogus gambling deductions, like people picking
well,
up
you'd
lottery
have to have the
tickets.
winnings. You'd have to show the winnings to
Yeah,
get the
yeah,
deduction.
which
So
not many people have anyway. But okay, let's go to questions in the chat. Katie, what do we have?
Okay, so there was one question about, I feel like it's the about refinancing. So for HELOCs, we talked about up to 100,000. It's deductible if it's for a home improvement. If it's not for home improvement, then no. But what about cash out refinances? Like, isn't it a little tricky if it's a cash out, you get a 30-year fixed, 15-year, whatever mortgage, but like let's say you bought it and your original was 500,000 for the purchase, and then you do another 300,000 for the cash out later. could you still deduct up to the 750, or you cannot if you're not using it for home improvements?
It's a percentage, but really what the first thing to know about is grandfathering in. So if you had a mortgage before December 15th of 2017, you were allowed to keep $1 million worth of loan and you were grandfathered in. So you were getting $1 million deduction like the state that I mentioned before, instead of the new 750. The second you change the character of the loan and take money out, then you're disqualifying yourself from that grandfathering and you're now down to 750 max. And then there's the phase out. So you got to be really careful about taking money out unless it's a good investment.
Yeah,
Hmm. So you can
that's
still
important.
deduct up to the 750 if it's a cash out and you're not using it for home improvements?
If you ever use any of the money for anything other than home acquisition or
You're not
improvements,
supposed
it's
to. Okay.
disqualified and then there
Oh,
has
so
to
you
be
said a portion of
special.
it. I
Mm-hmm.
see.
Mm-hmm. But a
Yeah.
lot of people were doing cash out refis because the interest rate was
We're still-
2%. So
Mhm.
what if you're disqualified
Yeah.
2% on 300,000, you
Yeah.
know? But all again, devil in the details. You just
Yep.
keep those
And
records.
I don't even think that it's consistent with the definition of cash out loans per Fannie and Freddie because I think one of them, Freddie, allows you to take up to like 2% of the loan amount as additional cash and still have it constitute a rate and term refinance and not a cash out refinance. But to the IRS, that might be different. That will disqualify them from the mortgage interest deduction.
Hmm.
Details, details.
I did a cash out refi and I bought more property. I bought rental property. So then I used that interest and I deducted on my rentals.
That's another way to do
Yep.
it.
Yep. And there's a really good tax code section that allows you to reassign mortgage interest to rental properties. So say you use your cash out refi for it, or you use your HELOC for buying a
Mm.
rental property, you can reassign that interest to the property, even though it's not.
If it's encumbered with a
Oh,
different property.
Mm-hmm.
Yeah,
Mm-hmm.
that's a really good point.
Yeah.
Okay. Any other questions, Katie?
that was it. So I feel
Oh,
like
great.
we're gonna finish right on time and we answered the
Okay.
question.
A quick reminder that our next quarterly webinar is Thursday, February 12th, and the topic will be real estate investing, some of which we touched upon tonight. And I just want to again thank you to Aaron Rubin and Louise Cochran for spending time this evening to impart their wisdom. And good luck with tax season. And it's really just like year round now. But thank you so much. We really appreciate your time.
This
Thanks
was
for having me.
enjoyable. Thank you.
Thanks, everybody. Are we going to stay open?
All right, we'll see y'all.
All right. Have a great evening, everybody.
Bye.
Bye.